You know, have you ever looked at a massive, complex corporation and just wondered, how does anyone actually know what's going on inside? I mean, without complete chaos, how do investors, owners, or even the government truly understand the health of a business? Well, the answer isn't magic. It's actually a universal financial rulebook, a strict set of laws that takes thousands of chaotic daily transactions and somehow translates them into a single, undeniable truth. Welcome to this explainer. Today, we're diving right into the foundational DNA of corporate finance in Vietnam, Vietnam Accounting Standard Number 01, or VAS 01 for short. You can really think of this document as the absolute grammar of the business language. Just like you can't write a coherent sentence without grammar, right? Well, a company just cannot communicate its true value without these overarching standards.
Okay, let's dive into this. Here is our roadmap for today. 1. The language of business. 2. 7 core principles. 3. 6 basic requirements. 4. The financial picture. 5. Measuring performance. And 6. Recognition rules.
Section 1. The language of business. Creating transparency and trust.
Think about it. If every single company just decided to count their money and value their assets in their own completely unique way, the economy would literally collapse into confusion overnight. Investors wouldn't be able to compare a scrappy tech startup to a giant manufacturing plant. We absolutely need a shared language so owners, auditors, and everyday investors can perfectly understand each other. The exact wording from VAS 01 states its purpose is to regulate and guide basic accounting principles, ensuring financial statements reflect honestly and reasonably. So this isn't just about doing math. It's about integrity. It establishes a unified, standardized framework for the truth, applying to every single enterprise across all economic sectors.
Section 2. 7 core principles. The mindset of accounting.
Now we're moving from that big picture purpose right into the foundational rules. You can basically treat these 7 principles as the absolute laws of physics governing every single financial decision a business makes in Vietnam. Let's quickly run through this philosophical groundwork. First is the accrual basis, which we'll look at closer in just a second. Then, going concern, meaning we assume the business will keep operating normally into the foreseeable future, no shutting down tomorrow. Historical cost demands assets are recorded at their original purchase price, not what you might wish they were worth today. Matching ensures revenues and their related expenses are perfectly paired up. Consistency means you can't just flip-flop your accounting methods every month to make the numbers look better. You got to stick with them uniformly for at least a year. Prudence is all about caution. Don't overestimate your assets and definitely don't underestimate your debts. And finally, materiality, which means any piece of info significant enough to alter an investor's decision absolutely must be included.
Now, I know accrual basis sounds a bit like a spell from Harry Potter, right? But it's actually the secret to seeing true economic reality. Under the accrual basis, you record a transaction the exact moment it happens, completely regardless of whether the cash has changed hands yet. Say you deliver a service today, well, you record that revenue today, even if the client doesn't pay you until next month. It stops businesses from manipulating their financial reality just by playing games with cash payments. It tells you what's actually happening on the ground.
Section 3. 6 basic requirements. The quality control.
All right, we've established the mindset, but now we need to look at the strict quality control checks required for the resulting financial data. Having principles is great, but ensuring the data you publish is actually useful is a whole different ballgame. So the crucial point here is that these 6 requirements must be applied simultaneously. The data has to be honest, based on real, verifiable evidence. It must be objective, completely free from any distortion or bias. It needs to be complete, leaving absolutely no transaction behind. It has to be timely, reported without delay. It must be understandable to someone with just an average knowledge of business. And lastly, it must be comparable across different periods and companies. You literally can't be timely but sacrifice completeness. They are all mandatory, all at once, no exceptions.
Section 4. The financial picture. The vital organs of a business.
Let's move from these abstract rules to the concrete elements that actually make up a company's balance sheet. If the rules are the laws of physics, these elements are the vital organs keeping the business alive. And here's where the accounting way really contrasts with the average person's way of thinking. To an accountant following VAS 01, assets aren't just stuff you own. They are resources you control that have the potential to bring you future economic benefit, like making products, paying off debts, or distributing wealth. Pitted directly against that are your liabilities. These are your present obligations from past events that you absolutely have to settle using your own resources. So it's what you control for future gain versus what you are legally bound to pay out.
And that leads us to the ultimate bottom line of the balance sheet. According to the standard, equity is the capital value of the enterprise, calculated simply as the difference between assets minus liabilities. It's delightfully simple when you really break it down. True owner value isn't some complex, mystical calculation. It is simply whatever value is left over in your controlled assets only after every single one of your obligations has been met.
Section 5. Measuring performance. The income statement.
While a balance sheet shows us the financial health of a company at a specific frozen moment in time, we obviously also need a way to measure the actual performance, the score of the business over a period of time. And this setup brilliantly illustrates how the big picture comes together. We have the balance sheet on one side dealing with assets, liabilities, and equity, and on the other we have the income statement, tracking the dynamic flow of the business, revenue and other income representing the economic benefits flowing in, expenses representing the economic benefits flowing out, and profit serving as the ultimate measuring stick of performance. It neatly organizes every single financial transaction into one of these fundamental categories.
Section 6. Recognition rules. The triggers for action.
So now that we know the elements, we have to ask, when exactly do these things get officially written down in the books? Well, VAS 01 does not leave this up to guesswork. There are very specific triggers. To recognize any element, an asset, a liability, revenue, expense, it absolutely must pass this mandatory two-step test. Step 1. It must be probable that a future economic benefit will flow into or out of the enterprise. Step 2. The item must have a value that can be measured reliably. If it doesn't have a reliable measurement, or if that economic benefit isn't probable, it does not go on the official financial statements, period. It is the absolute ultimate gatekeeper of the accounting records.
And we absolutely have to connect these recognition rules back to one of our core principles, the matching principle. This is crucial. When you record revenue because you made a sale, the exact corresponding expense required to generate that specific revenue must be recorded in the exact same period. Think about it. If you record the revenue of a sale but intentionally hide the cost of the goods sold until next year, you're creating a dangerous, completely artificial illusion of profit. VAS 01 explicitly forbids this.
Which brings us to our ultimate takeaway. Accounting standards like VAS 01 might seem a bit dry on the surface, filled with rules about accruals and recognition criteria. But at their core, they aren't just math. They are the bedrock foundation of economic stability. They guarantee that when a company says it's profitable, it actually is. So, as you look at the complex business world around you, remember this. If business is fundamentally a game of trust, are your numbers speaking the right language? Thanks for joining me on this explainer, and I'll catch you on the next deep dive.